Welcome back to the deep dive. We're here again to really plunge into complex topics, pull out those essential nuggets you need.
Get you truly well informed.
Exactly. And today we're tackling something that, well, at first glance, it looks like one thing, right? One part of the investment world. But when you actually look closer, it's like two completely separate universes. We're talking about mutual funds versus hedge funds.
Big topic.
Huge. They both pool money, sure. But their philosophies, how they're built, they're very DNA worlds apart. We'll get into that.
Absolutely.
So whether you're maybe aiming for a career in finance or you're already investing and want to, sharpen your understanding.
We're just curious about how this stuff actually works.
Right. Or just plain curious. Grasping these differences isn't just academic. It's critical. It's about understanding what dictates risk, returns, even who gets to play.
Yeah, your access.
Our mission today, a real deep dive. Comparing these two powerhouses across the board. Regulation, strategies, fees, transparency, the works.
Laying it all out.
So you walk away with a really clear picture. Okay, let's start unpacking this.
And it's so important to get this right away. These aren't just like surface differences. They're deeply linked. Everything connects.
How so?
Well, take a hedge fund's flexibility, its ability to use leverage or short stocks. That comes directly from its regulatory setup, which in turn dictates who can invest. It's all tied together.
Got it.
So for you listening, this deep dive really highlights a crucial choice point. Do you go for the low-cost, easy-access, liquid market exposure of mutual fund, built for everyone, really?
Standard route for many.
Or do you aim for those potentially high, maybe market uncorrelated returns from a hedge fund, knowing you're facing much higher fees and your money's locked up?
Big trade-offs.
Huge trade-offs. And making the right choice for you. That really hinges on understanding how these pieces fit together.
That's a perfect starting point. Let's jump right into the foundation then, because how they're built, that's not just semantics, right? It's baked into their legal code, their operation.
Yeah, exactly.
It sets the stage for everything else. Like you said, the first domino, public trust or private partnership, that choice dictates the game.
Precisely. Let's start with the familiar one, the mutual fund. Okay, so at its core, a mutual fund is an investment company. It's registered with the SEC. It's open-end.
What does open-end really mean in practice?
Good question. It means it continuously issues new shares when people invest and buys back shares when people redeem. Every day. Its purpose is pretty clear. It's about making investing accessible, democratizing it.
For the average person.
Exactly. It pools money from lots of people, maybe thousands or millions, into one big pot.
Okay.
Then that money is professionally managed. They buy a diversified portfolio, usually stocks, bonds, things that are easy to buy and sell quickly, liquid stuff.
So you get diversification and professional management without needing a fortune.
Right. And economies of scale, spreading costs, research, trading, admin across a huge asset base. It makes it affordable. Things you couldn't easily do on your own.
Makes sense. And operationally, that open-end thing?
Yeah, that's key for liquidity. Because it's always issuing and redeeming shares daily at the net asset value, the NAV.
Calculated once a day after market close.
Calculated once daily, yep. It means you, the investor, have high liquidity. You can generally get your money out pretty fast. And to protect everyone involved, there's a board of directors. Importantly, a majority have to be independent.
Independent from the management company running the fund.
Exactly. It's all structured for public protection, which is why they face such robust regulation. That public nature demands it.
Okay, so that's the public regulated world. Now, flip the coin, hedge funds.
A totally different animal. We're talking a private investment vehicle. Pools capital, yes, but from a much smaller, usually much more sophisticated group.
And that name, hedge, does it still mean hedging risk?
Historically, yeah. The original idea was often about long-short positions, buying some stocks, betting against others to kind of hedge out market risk.
Okay.
But today, the goal is broader, often more aggressive, frankly. They're shooting for absolute returns.
Meaning positive returns no matter what.
That's the aim. Positive performance, even if the stock market's tanking. Ideally, returns that are uncorrelated with the main markets. That's the alternative aspect. Seeking profit even when things look grim elsewhere.
And this private status is really the key differentiator.
It's the bedrock. It dictates the whole structure. In the U.S., they're typically set up as limited partnerships.
Okay, explain that structure. LPGP.
Right. You have the fund manager as the general partner, the GP. They make the decisions, run the show, and importantly, have unlimited liability.
They're on the hook.
Big time. Then you have the investors, the limited partners, or LPs. They provide the capital, but their role is passive. Their liability is limited just to what they invested. They can't lose more than that.
Safer for the investor, liability-wise.
Correct. And for non-U.S. investors or tax-exempt ones, you often see offshore corporate structures instead. Now, this whole private setup relies on key service providers.
Like who?
Crucially, the prime broker. Usually a big investment bank. They do everything. Trade execution, clearing, holding the assets.
Custody.
Custody, yes. But critically, they provide leverage, borrowed money, and they facilitate securities lending, which is absolutely essential for short selling. Hedge funds couldn't do what they do without prime brokers.
Indispensable.
Totally. Then you've got the fund administrator. That's an independent third party. Their job is calculating the NAV, could be daily, weekly, monthly, and handling investor subscriptions and redemptions. Keeps the valuation objective.
Important for trust.
Very. And finally, an independent auditor checks the books once a year, verifies the financial statements.
Okay, so private structure, specific roles, key service providers.
Right.
But the real split happens with regulation, right? That 1940 Act.
This is the absolute crux of it, the defining fork in the road. By choosing to be private, not offering shares to the general public.
They avoid that whole public protection framework.
Exactly. A mutual fund, because it sells to everyone, falls squarely under the Investment Company Act of 1940. That law came out after the Depression, designed specifically to protect retail investors. It imposes all sorts of restrictions.
Like what kind of restrictions?
Strict limits on leverage, caps on how much they can put into illiquid stuff, rules forcing them to diversify. There's a whole safety net.
Belt for the average Joe.
Precisely. A hedge fund, though, structures itself as a private placement. They deliberately don't solicit the general public. They restrict investors to typically accredited investors.
We'll define that later, but basically people the SEC thinks are sophisticated enough.
Sophisticated enough, wealthy enough to understand the risks without needing all the 1940 Act protections. And by doing that, the fund legally gets exemptions from the Act's most restrictive parts.
So the exemption isn't a loophole, it's the whole point.
It's the central enabling feature. It's what unlocks the hedge fund manager's toolkit. Serious leverage, short selling anything, complex derivatives, putting huge bets on just a few ideas, even illiquid ones. Things a mutual fund manager literally cannot do.
So structure dictates regulation, dictates strategy.
Perfectly put. Now, one quick clarification on regulation post-2008. Dodd-Frank did increase oversight. Many hedge fund advisors, the management companies, now have to register with the SEC if they manage over $150 million in private funds. They file Form ADV.
So they are regulated now.
The advisor is subject to reporting, SEC exams, anti-fraud rules, yes. But, and this is critical, it does not impose the 1940 Act's activity restrictions on the fund itself. Those core freedoms, leverage, shorting, concentration, remain intact for the fund's investments.
Subtle but huge distinction. Advisor registration versus fund activity limits.
Exactly. Which brings up that key question for you, the investor. Does all this freedom for the hedge fund actually lead to better returns after fees, or does it just mean more risk and complexity? That's the fundamental trade-off we keep coming back to.
Okay, that foundational difference is crystal clear now. Structure is destiny, essentially. But let's get practical. How does this play out day to day for the funds and for investors? Let's break it down across, say, 6 key areas, starting with the rule book itself, the regulatory frameworks.
So for mutual funds, you said it's like a detailed instruction manual. Very prescribed.
That's a great analogy. They operate under comprehensive, very specific oversight from the SEC via the 1940 Act. It's all about protecting the public investor. Think strict leverage limits.
Right. You mentioned they can't borrow much.
Barely. They can't issue debt. They can only borrow from banks. And even then, they need 300% asset coverage. So for every $1 borrowed, they need $3 in assets. Effectively caps borrowing at 1/3 of assets. Very conservative.
Designed to prevent blowups.
Exactly. Then illiquid securities. Big restriction there. A mutual fund can't have more than 15% of its net assets tied up in things it can't sell within 7 days.
Why is that rule so important? It directly enables their daily liquidity promise. Ensures they can always meet redemptions without having to dump hard-to-sell assets at bad prices.
Makes sense. Keeps the system flowing.
And diversification. If a fund calls itself diversified, it usually has to follow the 75-5-10 rule for at least 75% of its assets.
Okay, break that down, 75-5-10.
For that 75% portion, no more than 5% of the fund's total assets can be in any one company's securities, and the fund can't own more than 10% of the voting shares of any one company.
So prevents putting too many eggs in one basket or owning too much of one company.
Precisely. Double layer of diversification, plus the governance rules. Majority independent board, shareholder votes on advisors, standardized disclosure. It's a tightly controlled world.
Okay. And hedge funds. You clarified they're not totally unregulated, but the spirit is flexibility. How does that work in practice, avoiding those mutual fund rules?
Right. Unregulated captures the relative freedom compared to mutual funds. Their key is using those 1940 Act exemptions we talked about. Section 3C1 for funds with under 100 owners, and Section 3C7 for funds sold only to qualified purchasers. Those are the legal gateways out of the 1940 Act's main restrictions.
So those exemptions are the magic key.
They're the enablers. Now, post-Dodd-Frank, yes, advisors over $150 AUM usually register, file Form ADV. The SEC can examine them. But again, that's advisor oversight. It doesn't slap the 1940 Act's handcuffs on the fund's actual investing.
So the fund can still load up on leverage, short aggressively, concentrate bets.
Absolutely. Those core freedoms remain. And connecting this back, these rules, or the lack of them for hedge funds in certain areas, aren't just technicalities. They shape what's possible. Mutual funds, safety, stability, diversification for the public. Hedge funds, flexibility, complexity, potential for high returns, and risk for sophisticated players.
Okay, so that regulatory split directly creates this huge divide in who can even invest. Public access versus, well, a more privileged group.
Couldn't be clearer. Mutual funds are designed for everyone, open to all. That's why they have low minimum investments, often just a few $1,000, sometimes less, especially in retirement plans.
And you can buy them anywhere, basically.
Super accessible, brokerage accounts, direct from Vanguard or Fidelity, through an advisor. Easy. They're the main tool for retirement, college savings, just general investing for millions. The backbone.
But if you want into that hedge fund world, you need the credentials, right? High bar.
A very high, legally mandated bar. They cannot sell to the general public. To keep those vital 1940 Act exemptions, they must limit investors to those meeting specific SEC criteria for wealth and sophistication. The main one is being an accredited investor.
Okay, how does someone qualify as accredited income? Net worth?
Both, potentially. For individuals, it's typically income over $200K or $300K with a spouse for the last 2 years, with the expectation it continues, or net worth over $1 million, individually or jointly.
But excluding the house, right? That's key.
Crucially, yes. Excluding the value of your primary residence ensures its actual investment wealth, not just home equity. And recently, they added professional licenses holding a Series 7, 65, or 82 in good standing. Also works now. Recognizes expertise.
Interesting. And there's an even higher tier.
Yes. For funds using the 3C7 exemption, they need qualified purchasers. That's generally $5 million in investments for individuals, a significantly higher hurdle.
Wow. And the rationale is these folks can handle the risk.
That's the SEC's thinking. They're deemed sophisticated enough to do their homework, understand complex strategies, and absorb potential losses without needing the 1940 Act safety net.
So it's not just being rich, it's being sophisticated rich.
That sums it up pretty well. They have the capital and the presumed knowledge to navigate that less regulated, potentially riskier environment.
Okay, this is where it gets really interesting how they actually try to make money. The strategies. Vastly different toolkits.
Totally different playbooks. Mutual funds. Mostly confined to long-only positions in publicly traded liquid stuff, stocks, bonds. They buy things hoping they'll go up.
Simple enough.
Yeah, and their strategies are usually straightforward categories.
Yeah.
Stock funds, by size, like large cap, or style, like growth value. Bond funds, by credit quality or duration. Target date funds for retirement. Money market funds for safety.
And the goal for active ones is just to beat their benchmark, right? Like the S&P 500.
Beat the benchmark after fees. That's the key challenge for active mutual fund managers operating within these constraints.
Okay. Now, hedge funds.
Yeah.
You said go anywhere mandate. Sounds like the Wild West.
Well, not quite lawless, but the range of strategies is immense and complex. They use leverage, derivatives, short selling, all the tools denied to mutual funds specifically to generate alpha.
Alpha. Remind us what that is again.
Alpha is the return you get that's independent of the market's overall movement. It's supposed to come purely from the manager's skill or unique strategy. If the S&P 500 is down 10%, but a hedge fund makes 3%, that 3% is pure alpha. They made money despite the market falling.
A very different goal than just riding the market up.
Completely. And the ways they chase alpha are incredibly varied. You've got equity strategies, like long-short equity buying stocks you think will rise, shorting ones you think will fall, trying to profit both ways and reduce market exposure. Or equity market neutral, where they try to balance longs and shorts perfectly to eliminate market risk entirely. betting purely on stock picking skill.
Okay, betting on winners versus losers.
Then, event-driven strategies. Trying to profit from specific company events. Merger arbitrage is a classic. Buy the target company in a merger. Short the acquirer. Capture the price difference if the deal closes. Or distressed debt, investing in bonds of companies near bankruptcy, hoping to profit from a restructuring.
High risk, high reward stuff there.
Definitely can be. Then relative value strategies. Exploiting tiny price gaps between related securities. Convertible arbitrage is one long the convertible bond. Short the stock, playing mispricings. Needs complex models. You also have global macro strategies. Big picture bets on economies, currencies, interest rates, commodities based on geopolitical or macroeconomic forecasts. Think George Soros betting against the British pound.
Big directional bets.
Huge. And finally, quantitative quant strategies. Using complex math, algorithms, tons of data to find patterns, trade automatically, often at high frequencies. Renaissance Technologies is a famous example here.
Wow, so the sheer variety is staggering compared to mutual funds.
It's night and day. Mutual funds mostly ride the market wave. Hedge funds are trying to surf across the waves or even against them using every tool imaginable. It really highlights the difference in philosophy.
Right, and how the managers get paid. That tells a huge story about incentives. Big difference here, too.
Massive difference. Mutual fund fees are pretty transparent, relatively simple. The main one is the expense ratio.
That percentage taken out annually?
Exactly. An annual percentage of assets, maybe 0.5%, could be much lower for index funds, like below 0.1%. It covers management, admin, maybe marketing fees called 12B1 fees, straightforward cost for service.
And sometimes there are sales loads, commissions.
Sometimes, yeah. Front-end loads when you buy, back-end loads when you sell. But the trend is definitely towards no-load funds. Fees are generally designed to cover costs, not directly tied to massive outperformance in the same way.
As the hedge fund model, the famous 2 and 20.
Ah, yes, 2 and 20. Iconic. It really defines the hedge fund incentive structure. It's got two parts.
Okay, break it down. The 2.
The 2 is the management fee. Typically around 2% annually on the assets under management, AUM. This gets paid regardless of performance. Even if the fund loses money, the manager gets 2% of the assets.
Covers the lights, salaries, infrastructure.
Exactly. Operational costs. But then comes the 20.
The performance fee.
The performance fee. Typically 20% of the profits the fund generates each year. This is the big one. It's designed to align the manager's interests directly with the investors. Make money for the LPs, make a lot for yourself. No profits, no performance fee.
Huge incentive to perform. But are there protections for investors?
Yes, usually two key ones. First, a hurdle rate. The fund might have to earn a minimum return, say 5%, before the 20% performance fee kicks in on profits above that 5%.
Okay, so they don't get paid for just matching, say, T-bills.
Right. And second, the high watermark. This is crucial. It means if a fund loses money, it has to earn back all those losses and exceed its previous peak value before the manager can take a performance fee again.
Prevents getting paid twice for the same gains after a dip.
Exactly. Ensures they're paid on new profits. But even with these, the fee impact is massive. Let's run that example again.
Okay, $1 million, 10% gross return per year for 10 years.
In VTSAX, the Vanguard Index Fund, with its 0.04% fee, you end up with about $2,583,800. Total fees paid, roughly $6,500.
Peanuts, relatively.
Now, the hedge fund, same 10% gross return, but with 2 and 20, you end up with around $2,167,000. Total fees paid, over $420,000.
Wow. That is a staggering difference. Over $400,000 vaporized in fees on the same gross return.
It hammers home the point. A hedge fund has to deliver significantly better returns after fees just to be competitive with a cheap index fund. That alpha needs to be huge just to overcome the fee drag.
Raises a very important question. Is that alpha consistently achievable and worth the cost?
That is the multi-trillion-dollar question in finance.
Oh, okay. Beyond the fees, just getting your money out. Another fundamental difference. Huge implications for planning.
Absolutely. Critical distinction. Mutual funds. Daily liquidity. It's basically guaranteed by law.
You can sell any business day.
Any business day, you redeem at the closing NAV. And the fund must pay you within 7 calendar days. Usually it's much faster in practice, maybe a day or two.
So pretty good access if you need the cash for something.
Makes them suitable for goals where you might need the money on relatively short notice. Retirement income, emergencies, house down payment. You know it's accessible.
But hedge funds. Different story. You're locking up your capital.
Completely different beast. Illiquidity is often a feature, not a bug, for hedge funds. It's necessary for their strategies.
How so?
Well, many strategies involve assets that are hard to trade quickly. Private equity, distressed debt, complex derivatives. They need a stable capital base to execute these long-term ideas without worrying about investors pulling money out constantly.
So they restrict withdrawals to keep that stable base.
Exactly. There's several mechanisms. First, lockup periods. Your money is literally locked up, often for 1 or 2 years. No withdrawals allowed. Sometimes soft lockups allow early exit with a big penalty.
Okay, so commit for a year or 2 minimum.
Often. Then, even after the lockup, you have redemption windows. You can only pull money out at specific times, maybe quarterly or semi-annually, not just any day.
So plan way ahead.
And you need to give notice periods, usually 60, 90 days written notice before the redemption window.
More planning.
And finally, gates. If too many people want out at once, like during a crisis, the manager can invoke a gate limiting total redemptions on that date, say to 20% of the fund. You might only get some of your money back and have to wait for the next window for the rest.
Wow. So you could be stuck even after the lockup if there's a rush for the exits.
Absolutely. Connecting this back, this profoundly impacts financial planning. Can you really afford to have that capital tied up, potentially inaccessible for years, even in an emergency? It limits hedge funds to being a wealth enhancement tool, not core savings.
And the final pillar, transparency, how much do you actually get to see? Open book versus, well, the black box.
Good way to put it. Mutual funds are the open book. Federal laws mandate tons of disclosure.
Like the prospectus.
The prospectus is key. Standardized document you get before investing. Details, objectives, strategy, risks, fees, performance, everything.
Required reading, essentially. It's supposed to be. And then you get regular shareholder reports, semi-annually and annually. Financial statements, a full list of portfolio holdings, management discussion.
You can see exactly what stocks they own.
Yep, usually with a bit of a lag, but you see the holdings.
Yeah.
And all this is filed publicly with the SEC on ADGR. Anyone can look it up. Highly transparent.
Okay, now hedge funds. Much less sunlight,
yeah.
right? They say it's strategic.
That's the argument. Lower transparency is seen as necessary to protect their proprietary strategies. Revealing detailed holdings or techniques would give away their edge, let others copy them.
So what do investors get instead of a prospectus?
They get a private placement memorandum, PPM. It describes the strategy, risks, terms, but it's not standardized. Detail varies hugely. Can be quite vague compared to a prospectus.
And ongoing reporting.
Usually limited. Monthly or quarterly performance statements, just return numbers often, annual audited financials. But getting a detailed, timely breakdown of what's actually in the portfolio, very rare.
Even with Dodd-Frank and Form ADV. Form ADV is about the advisor's business, their AUM, employees, potential conflicts. It's not a window into the fund's real-time holdings or trades. So yeah, the black box analogy holds. The inner workings remain largely hidden.
It's fascinating how it all links. Opacity protects the strategy, which justifies the fees, which funds the complex strategies only possible due to the regulatory exemptions.
It's a completely self-reinforcing ecosystem. Totally different logic than the public, transparent world of mutual funds.
Okay, this has been great theory. Let's make it more concrete. Let's look at some of the actual giants in each world. See these strategies and structures in action. #, read hedge fund case studies.
Good idea. Let's start with hedge funds. First, maybe Bridgewater Associates, Ray Dalio's firm, usually cited as the world's largest.
What's their game?
They're pioneers of global macro, making huge bets based on big-picture economic and political trends worldwide. Currencies, interest rates, commodities, the whole shebang.
Based on Dalio's economic machine ideas.
Exactly. Very systematic, principles-based approach. And their clients are the biggest players: governments, central banks, giant pension funds. Very institutional.
Any specific famous strategy?
Their all-weather strategy is legendary. It basically founded risk parity investing. The goal is to build a portfolio that performs decently across 4 economic scenarios: rising growth, falling growth, rising inflation, falling inflation.
Balancing risk, not just dollars.
Precisely. It aims for stable, absolute returns, regardless of the economic season. Quintessential hedge fund, objective, consistent performance, independent of market direction.
Okay, who else? How about the super quantitative ones?
Then you have to talk about Renaissance Technologies, Jim Simon's firm, the ultimate black box.
Famous for hiring mathematicians and physicists, not finance guys.
Exactly. PhDs in hard sciences, legendary secrecy. Their medallion fund, only for employees now, close to outsiders for decades, is probably the most successful hedge fund ever.
The returns are astronomical, right?
The reported numbers are staggering, something like 66% average annual returns before fees since the late 80s. It's just unreal.
How do they do it?
Complex mathematical models, analyzing petabytes of data, finding tiny non-random patterns, millions of automated, often high-frequency trades. Simons apparently said they only need to be right slightly more than half the time, like 50.75%, but over huge volume, it compounds massively. Pure quant power.
Mind-boggling. Okay, one more. Maybe a different style.
How about Citadel LLC, Ken Griffin's firm? A great example of a multi-strategy powerhouse.
Meaning they do lots of different things under one roof.
Exactly. It's like a platform. They have numerous separate investment teams, each focused on a specialized strategy: long-short equity, fixed income arb, commodities, quant, like mini hedge funds within the firm.
That manage centrally.
Yeah, Citadel provides the capital, tech operations, and crucially, has very strong centralized risk management overseeing all the teams. They dynamically allocate capital to the teams or strategies that look most promising. Aims for diversified, uncorrelated returns overall.
Interesting model. You mentioned AUM discrepancies for firms like Citadel.
Yeah, it's a good point. You'll often see different AUM numbers reported by different sources for these big private firms.
Yeah.
What's fascinating is this opacity, this lack of standardized public reporting. It's part of the deal. It protects their edge, but it also means investors have to operate with less complete information, placing huge trust in the manager. Very different from the public fund world. #, be eerie. Mutual fund case studies. The titans of asset management.
Okay, let's flip to the mutual fund side now. Dominated by giants, often focused on low-cost passive indexing, right? Household names.
Absolutely. And you can't talk mutual funds without mentioning the Vanguard Total Stock Market Index Fund, VTSAX. It's colossal.
How big are we talking?
The strategy has over $1.9 trillion in assets as of mid-2025. It perfectly embodies Jack Bogle's passive philosophy: own the entire market, keep costs ultra low.
So it just tracks the whole U.S. stock market.
Pretty much. It tracks the CRSP U.S. Total Market Index, large, mid, small caps, nearly everything investable in the U.S.
Yeah.
Uses inbox sampling to replicate it efficiently.
And the cost?
Dirt cheap. Expense ratio is 0.04%. Tiny. Very low turnover, too, so it's tax efficient. It's the core holding for millions seeking broad U.S. market exposure. Buy and hold investing personified.
Okay, another big index player.
Fidelity 500 Index Fund, FXAIX. Another behemoth, strategy assets over $665 billion. Tracks the S&P 500 index, the 500 largest U.S. companies.
So large caps only, but still huge diversification.
Significant diversification, yeah. And the cost. Even lower than Vanguard's total market fund, in this case, just 0.015% expense ratio. It's practically free.
The fee war is real.
It really is. These massive ultra-low-cost index funds have revolutionized investing for the average person.
And then there's the biggest manager of all.
BlackRock, the world's largest asset manager, period. Over $12 trillion under management. They dominate across the board.
Passive and active.
Both. Huge leader in passive through their iShares ETFs, like the iShares Core S&P 500 ETF, IVV, a direct competitor to FXAIX. But they also manage a massive range of actively managed mutual funds.
So they play in both worlds.
They do. Plus, they provide sophisticated solutions and risk tech, like their Aladdin platform, to huge institutions. What BlackRock shows is how one firm can operate successfully in the accessible, regulated mutual fund world and the complex institutional space. But they do it with very distinct products and approaches for each market.
Right. So for you, the investor listening, choosing between these paths isn't just picking funds. It's deciding where you fit, what your goals are, what trade-offs you'll accept. Let's really unpack that choice. What's the core decision? #A. Risk, return, and suitability.
It boils down fundamentally to seeking beta versus seeking alpha. Remember those terms.
Beta is market return. Alpha is skill-based return above the market.
Exactly. Beta is the return you get just from being exposed to the broad market's ups and downs. Low-cost index mutual funds are brilliant tools for capturing market beta efficiently. For most people, that's the core of long-term investing, participating in overall economic growth. The main risk is just market risk, the whole market going down.
Simple enough.
Alpha is that extra bit, the return generated purely by the manager's skill or strategy, independent of the market. Hedge funds are built to chase alpha.
So not replacing market exposure, but adding something different.
Ideally, yes. For a high net worth investor, a hedge fund might be a satellite holding, aiming for diversification and returns that don't just follow the stocks and bonds and the rest of their portfolio, but the risks are way more complex.
Like what?
You've got strategy, risk, the specific strategy just might not work anymore. Manager risk, the star manager loses their touch. And risks from leverage, amplifying losses, or getting stuck in illiquid assets, it's a different ballgame.
So the crucial question for the investor is,
Are you primarily seeking market growth, beta, and willing to ride the market waves? Or are you trying to beat the market, alpha, seeking uncorrelated returns and willing to accept higher costs, complexity, and different kinds of risk? That choice dictates whether mutual funds or hedge funds even make sense for you. Hashtag tag 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 hotag B, the true cost of investing.
we hit the fees hard earlier, but it's worth hammering home again. The long-term impact is just massive.
Can't overstate it. Let's quickly revisit the $1 over 10 years at 10% gross return example one last time.
Okay.
Mutual fund, VTSAX, 0.04% fee. Total fees just over $6,500. Ends with $2.58 million. Hedge fund, 2 and 20. Total fees over $420,000. Ends with $2.17 million.
Same performance before fees, over $400,000 less after fees due to the structure.
It underscores the critical point. Hedge funds need outstanding net performance just to justify their existence compared to cheap beta. That alpha has to be consistently huge. What's fascinating, or maybe alarming, is how easily those high fees can silently erode wealth, turning good gross returns into mediocre net results over time. Hashtag tag 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 stage in. Due diligence.
And just getting into these is vastly different too, right? Not just the money, but the whole process.
Oh, completely different worlds. Mutual funds. You can research online, read reviews, check Morningstar, buy shares in minutes on your phone with maybe a small minimum.
Public info, easy access.
Exactly. Due diligence is simplified by the standardized prospectus and tons of third-party analysis. Hedge funds. First, you need an introduction. Private bank, advisor, fund of funds. Then you have to prove you're accredited or qualified share financial details.
More hurdles.
Then comes the real due diligence. It's arduous. Deep dive into the PPM, legal reviews of complex partnership docs, background checks on the manager, checking their operations, and you're doing this with limited public data. It's a complex, expensive, time-consuming, way beyond most individuals. Hashtag tag 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 D. Liquidity and financial planning.
And tying it all together, liquidity. How quickly you can get your money dictates where these fit in your life plan.
Absolutely fundamental. Mutual funds' daily liquidity makes them suitable for almost any major life goal, where you need access, retirement income, college funds, house savings. You can sell systematically, liquidate for emergencies, predictable access.
The bedrock for most financial plans.
For most, yes. Hedge funds' illiquidity, the lockups, gates, notice periods means this is capital. You must be able to set aside for potentially many years without needing it. It's not on demand, even in a crisis.
So definitely not your emergency fund.
Absolutely not. It's only appropriate for wealth enhancement after your core liquidity and financial security needs are solidly met elsewhere. So, connecting to the bigger picture, it's not just an investment decision, it's a lifestyle and planning decision. Can you live without access to that chunk of money for years?
Okay, let's flip the perspective one last time. What's it like for the manager? Choosing between running a mutual fund versus a hedge fund sounds like two totally different careers. Hashtag tag 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 A day in the life.
Oh, absolutely. A day in the life of a hedge fund manager. Intense, unstructured, high-stakes hunt for alpha. Often starts crazy early, 4 or 5 a.m., scanning global news, overnight markets.
Looking for that edge?
Always looking for an edge. The day could involve anything from coding sessions with quant PhDs testing models to deep niche research on some obscure corporate event to networking intensely for non-public info. Legally, of course.
High conviction bets?
Leverage. Often, yeah. Big positions, maybe complex derivatives, plus constant intense risk management, stress tests, scenario analysis, and they're entrepreneurs too, marketing to LPs, managing those relationships. The pressure is immense. Poor returns can literally kill the firm.
Wow. Sounds exhausting. And a mutual fund manager.
Comparatively, more structured, more process-driven, operating within those clear regulatory and prospectus lines.
So less Wild West.
Definitely. Starts with team meetings, reviewing earnings, economic data, lots of traditional fundamental research meeting, company management, conferences, building financial models. Decisions are always relative to the benchmark. How does this affect my tracking error? Managing daily cash flows from investors buying and selling is also a big part.
Then for index fund managers.
Even more process-driven. Focus purely on executing trades efficiently to minimize tracking error against the index. Precision execution is key. Hashtag B, freedom versus constraint.
That really highlights the freedom difference. Hedge fund, go anywhere. Mutual fund, stay within the lines.
That's the essence of it. Hedge fund PMs have incredible freedom asset classes, geographies, instruments. It fosters this entrepreneurial, creative, often contrarian vibe, constrained only by their own ideas and the broad PPM.
Rewarding uniqueness.
If it works, mutual fund PMs. Dual constraints, 1940 Act rules, plus the fund's specific prospectus rules, and they're constantly tethered to that benchmark. Fear of underperforming often leads to benchmark hugging, playing it safe, staying close to the index.
Creates different personalities, maybe.
You could argue that. Hedge funds reward contrarianism, high-risk tolerance, obsession with being different and right. Mutual funds, especially big firms, reward disciplined process, teamwork, delivering modest outperformance within a compliance-heavy setup. Avoiding big mistakes is often key. #3 risk management philosophy.
And how they think about risk itself must be different, too.
Fundamentally different focus. Hedge fund managers focus on absolute risk. Their primary goal, don't lose money, period, regardless of the market. They use shorts, derivatives, hedges to aim for profit, even if the market tanks. Protecting capital is paramount.
Shelter from the storm.
That's the idea. Mutual fund managers. They focus on relative risk, measured as tracking error against their benchmark.
So how far they stray from the index.
Exactly. For them, risk isn't necessarily losing money in absolute terms. If the market falls 20% and their fund only falls 19%, that's outperformance relative to the benchmark. Success, even though investors lost 19%.
Huh. A very different definition of risk and success.
Totally. Their nightmare isn't losing money, it's losing more money than the benchmark, straying too far and being wrong. #DEGI. Compensation and incentives.
And the pay structure reflects all this perfectly, right? Aligns incentives very differently.
Perfectly. Mutual fund managers, typically salary plus bonus. Bonus tied to performance relative to benchmark, maybe AUM growth, following the rules. Stable corporate career path.
Predictable growth.
Generally. Hedge fund managers. Compensation dominated by that performance fee, beat what you kill.
The 20% of profits.
Right. It creates this hugely asymmetric payoff, potentially unlimited upside. A great year means a massive windfall, drives that intense, risk-taking entrepreneurial culture. They're direct equity partners in their ideas.
So the career choices.
Steady corporate growth versus a high-risk, high-reward entrepreneurial gamble. Stable path versus potential lottery ticket, with the very real risk of going bust. #outro.
Wow, okay, what an incredible deep dive. Two worlds that look similar from afar but are just profoundly different underneath.
Truly distinct ecosystems.
And the key takeaway, really, is that the difference isn't just a matter of degree, it's one of kind. It all stems from that fundamental split in securities law, public versus private.
Exactly.
Mutual funds. Public markets, transparent, liquid, accessible, regulated for the everyday person.
Built on trust and broad access.
Hedge funds, private markets, opaque, illiquid, exclusive, freed from constraints for complexity, and yes, higher risk.
Designed for sophistication and alpha generation.
And every difference we discussed, fees, liquidity, strategy, the manager's life flows directly from that initial public-private choice.
It all connects back.
You mentioned liquid alts trying to bridge the gap.
Yeah, those regulated mutual funds or ETFs using derivatives to try and mimic hedge fund strategies.
But they can't really replicate it fully.
Not really. The 1940 Act rules on leverage, illiquids, diversification. They just can't get the same freedom. It's a diluted version, constrained by the public structure. The core worlds remain distinct, which leads to the final conclusion. Neither one is better. It's entirely about fit. It depends completely on your individual circumstances. Right. Mutual funds. They're the foundation for most investors. Low cost, transparent, liquid way to get market exposure, build wealth over time.
The bedrock.
The bedrock. Hedge funds. They're a specialized tool for wealthy, sophisticated investors or institutions. High-cost, illiquid, complex. Used for diversification, chasing absolute returns after the core financial needs are met.
So connecting it all.
The goal for you listening is to make an informed choice, one that truly aligns with your wealth, your risk tolerance, your time horizon, your specific goals. Understand the trade-offs we've discussed.
And maybe a final thought to leave people with.
Well, thinking about how investing is changing. More individuals getting access, more complex tools available. It raises an interesting question. How much of that hedge fund toolkit can an accredited individual really manage effectively on their own? And at what point does chasing alpha, especially with those high fees built into funds, just become a really expensive, complicated way of getting market beta anyway? Maybe with extra steps and extra risk, something to mull over.
Definitely something to think about. A great place to wrap up. Thank you for joining us on this really deep dive into mutual funds and hedge funds.
My pleasure.
We hope you feel more informed, more empowered. Keep learning, keep questioning, keep thinking critically. We'll catch you next time on The Deep Dive.